Hi, this is Michael Regan with the Regan Team Home Loan Group, and welcome to this week's Real Estate Roundup. Now to pending home sales. So pending home sales were down 0.8 month over month and down 0.4 year over year. And that was really due to really bad weather on the East Coast. Because if you look at the Midwest and the West Coast, sales were up and up considerably. Now to PCE, which is a measure of inflation, and that showed that the headline year over year was at 2.9% and core was at 3%. We saw a 0.4 tick up on both the headline and the core, and that was hotter than forecasted, which is overall not good for interest rates. Now, this was mainly due to increased streaming subscriptions, including Netflix, Disney, etc. Their costs went up over 20% in the month of December, which really increased the PCE index. Now to new home sales for December. So month over month, they were down 1.7%, but they are up 3.8% year over year. Now, the crazy thing is, you'll see that there's a 7.6 month supply of new homes, but that isn't accurate because only 123,000 are actually completed. Most of them are either under construction or just dirt. So this actually shows that there's not a lot of inventory for new homes that are ready to go. And so the numbers being down month over month is not a surprise, but year over year, that's a really good number and shows just the demand for housing. Now to new home construction starts and permits. So this is showing what inventory is coming down the line. And essentially what we're seeing is that permits are down 2.2% year over year. Starts are down 7.3% year over year. Construction is down 10.5% year over year. And completions are down 1/10 year over year. So what this is showing is home building is slowing. That's going to be good for anyone who's got a house in the future because home builders can't start and stop very quickly. And so now with interest rates and just the market having slowed a little bit last year, what that did is that stopped builders from building new projects and doing a lot of the things that they would need to do to keep up with just a normal pace of population growth. And that's slowing down. So with only 1.45 million permits even pulled, and that doesn't mean they'll all be completed, you're really not even keeping up with the household formation. So again, it's going to push a lot of appreciation to the future so that if you buy a house now, it's going to be good for you because housing is just going to get more expensive because we're just not building enough. And this ties into why home builders are not building a lot of new homes because their sentiment's not great. So anything under 50, home builders are feeling pessimistic about what's going on in the market. So buyer traffic, 22, future sales 46 and current sales 41. So realistically, even though there's not a lot of inventory, builders aren't feeling really positive about the amount of sales going forward. Now, this is obviously due to a lot of combination of things, including geopolitical events, difficulty getting supplies, labor, all those kind of things. But the whole thing is if builders don't feel confident and they don't build, well, our population isn't going down. We continue to have increased household formation. And so if we're not building to just keep up with the normal household and population growth, well, guess what? We're going to continue to have a shortage of homes and prices are just going to get more expensive. Now to the Case-Shiller Home Price Index. And this is really the gold standard in the industry for tracking true appreciation. Showed in December, we were up 0.4 month over month and 1.3% year over year, which was really great news. Again, you're not seeing crazy appreciation, but the point is we're not seeing deceleration. Home prices overall in most areas are not going down. They may not be going up 20% like we got spoiled during COVID, but nonetheless, they are going up. And if you just stack that appreciation, that's how wealth is built. And it'll speed up in the years forward, especially as interest rates come down, appreciation is going to go up. Now, this shows active listings compared to fourth quarter of 2019, which is considered the more normal market before our pandemic, to quarter four of 2025. And it shows in California, we're down 6% from listings. What you can glean from that chart is that there's a lot of articles out there that say home prices are going to crash, that there's way too much inventory and it's a terrible time to buy. But what that chart shows us is that's quite frankly baloney. We have less inventory than we had in 2019, and no one in 2019 was talking about a housing market crash. It just shows that we do have a lack of inventory and we still have a lot of demand. And as rates come down, that's going to increase. That's just going to drive up home prices. Now to what the market's doing today. So we're down 8 basis points in the Fannie Mae 30-year fix. You see the chart. Green is good for rates. Red is bad. So we've had a lot of red lately. Had a little green last week, which was good news, but again in the red today. So rates are still very good. They're at the best levels that we've had in many years and match what we had around January 9th. So that's a good news that we've had that good run up. But obviously we have to be cautious because we are at very strong ceilings of support, and that could push us down for rates to get worse. Obviously, that's going to be really dictated by geopolitical events and other economic news. But nonetheless, that is where we are this week. That's it for this week's update. And don't forget, we specialize in cash flow loans for self-employed business owners and reverse mortgages. Have a great week.